So let's dive into our topic. So first of all, we are discuss what are derivatives. Derivatives are financial contracts whose value depends on an underlying assets like a stock, bond or commodity. They help investor manage risk or make profit without directly owning the asset. Derivatives play a crucial role in the financial world by helping individuals, businesses, and institutions manage their risk exposure. The derivative market is essential because it provides liquidity and allows participants to transfer risk among different parties. In countries like Pakistan, derivatives, though still developing, play a key role in stock and commodity markets. Their utility is growing as businesses become more aware of how to manage risk efficiently. There are some examples of firms in Pakistan involved in this market. Number 1, Karachi Stock Exchange. Number 2, Pakistan Mercantile Exchange. Number 3, State Bank of Pakistan. Number 4, mutual funds. Number 5, corporate risk management. Number 6, agricultural futures. Number 7, exchange traded funds, and etc. Now there are many types of derivative markets.
Number 1, futures contract. Futures are agreement to buy or sell an asset at a specific price on a future date. Example, a farmer agrees to sell a certain amount of wheat at a set price next year, protecting against price drops. Number 2, options. Options give the buyer the right but not the obligation to buy or sell an asset at a specific price before a certain date. Example, an investor buys a call option for shares of a company, allowing them to buy the shares at a fixed price if the market prices rises. Number 3, swap. Swaps are agreements between two parties to exchange cash flows or financial instrument. Common types include interest rate swaps and currency swaps. Example, a company exchanges its fixed interest rate payment for floating rate payment with another company to better match its cash flow needs. Number 4, forwards. Forwards are similar to futures but are private agreements between two parties. They are not traded on exchanges and are customizable. Example, a business agrees to buy a specific amount of oil at a set price in 6 months, tailored to its specific needs. Number 5, credit derivatives. Credit derivatives are contracts that allows one party to transfer the credit risk of an underlying asset to another party. Example, a credit default swap protects a lender from the risk of default by a borrower, allowing them to sell the risk to another party. Now we are explained only 3 of the types very deeply, which are important. Number 1, options. Definition. An option gives you the right but not the obligation to buy or sell an asset at a certain price before a specific date. Options are one of the most common types of derivatives. They provide the buyer with the right but not the obligation to buy or sell an asset at a specific price within a predetermined time frame. Options are used by investors to either speculate on the movement of an asset's price or to hedge against potential losses. There are 2 types of options: call versus put option. Call option allow you to buy and put option allow you to sell. Example, in the context of Pakistan, options are becoming increasingly popular, especially on the Pakistan Stock Exchange. Investors use these contracts to hedge against the volatility of stock prices or to speculate on the movements of major stocks. The companies in Pakistan's energy sector may use options to hedge against fluctuation in oil prices.
Assalamu alaikum. My name is Sayyid Ansar Bukhari. I am the student of Economic and Finance in Karachi University. My topic is to explain type of derivative market, future and swaps. First, I likely to explain future. Future are commonly used to hedge against the price change in commodities like oil, wheat, or currencies. They are popular among investors and businessmen alike. Future are another key type of derivatives, often used for trading commodities, currencies, and financial instruments. A future contract is an agreement to buy or sell an asset at a price on a specific future. Pakistan Mercantile Exchange, making them widely accessible for both individual and institutional investors. In Pakistan, future trading is significant in the commodity market, particularly for agricultural products such as wheat and cotton, as well as energy products like crude oil. Now I am going to explain swap. A swap is a financial agreement where two parties exchange cash flow or financial instrument. The most common type are interest rate swap and currency swap. Type of swaps: interest rate swap, exchange of interest payment, while currency swap, exchange of principal and interest in different currency. Swap are more complex derivative, but they play a critical role in the financial market by allowing two parties to exchange or swap their financial obligation. In simple terms, swap allow one party to take on the financial risks of another. A company type of swap is the interest rate swap, where two parties exchange interest rate payment. One may have a loan with a fixed interest rate, while other has a loan with a variable interest rate. Through the swap, one party buy the interest rate risk of other, creating a balance that benefits both parties. In Pakistan, swap are frequently used in banking sector by large corporations to manage interest rate and currency risk. For example, a company that borrow in US dollar but earn revenue in Pakistani rupees may be exposed to currency risk due to fluctuation in exchange rate.
Assalamu alaikum. My name is Amna Zahra and I am a student of Karachi University, Department of Economics and Finance, third year. And my topic is importance of derivative market. Number one is risk management. Derivatives are essential tools for managing financial risk. They allow individuals and business to hedge against adverse price movement in assets such as stocks, commodities, and currencies. For example, a farmer can use futures contracts to lock in prices for their crops, reducing the risk of price fluctuation at harvest time. Similarly, a multinational company might use currency swaps to protect against exchange rate risks when operating in different countries. Number two is price discovery. The derivative market contributes significantly to price discovery, which is the process of determining the price of an asset based on supply and demand dynamics. The trading of derivatives often reflects the market's expectation about future price movement, helping to establish a benchmark for the underlying asset. The information is valuable for investors, analysts, and policymakers, providing insights into market trends and potential price changes. Number three is leverage and speculation. Derivatives allow investors to use leverage, which means they can control larger position with a smaller amount of capital. This can amplify potential gains, but it also increases the risk of losses. Many traders and investors use derivatives for speculative purpose, betting on future price movement without the intention of holding the underlying asset. While speculation can lead to significant profits, it can also contribute to market volatility. And number 4 is market efficiency. By enabling a wider array of trading strategies and allowing for the management of risks, derivatives enhance market efficiency. They provide investors with more options and flexibilities in their investment. This can lead to better allocation of resources and capital across the economy, ultimately contributing to overall economic growth. Number 5 is portfolio diversification. Derivatives offer investors the ability to diversify their portfolios beyond traditional assets like stocks and bonds. For example, through options and futures contracts, investors can gain exposure to different asset classes, including commodities, interest rates, and foreign currencies. This diversification can help reduce overall portfolio risks.
In this presentation, we are explored the derivative market, focusing on three main types of derivatives: options, futures, and swaps. Each of these instruments allow business and investors to manage risk effectively. Options provide flexibility in purchasing or selling assets, while futures offer a standardized contract for buying and selling commodities or financial assets at a future date. Swaps are explained allowed parties to exchange risk such as interest rate or currency risk, thereby stabilizing their financial outcomes. In Pakistan, the derivative market, though still developing, offers significant opportunities for business to hedge against market volatility. As the market matures, derivatives will become an even more essential part of the financial ecosystem in the country. Thank you.